interesting trends here. First of all, Bitcoin is digital gold. Second, Bitcoin is an emerging digital monetary network. Both of those are interesting and critical to corporate strategy. Let's talk about digital gold as harder money and market dynamics. Basic principle of market dynamics is capital is going to flow from weaker assets to stronger assets until every asset is equally attractive on a risk-adjusted basis. If I have one asset that's yielding 10% return and the other is yielding 5% return, and the risk premiums are exactly the same, then and the risk is exactly the same, then people are going to sell the one asset to buy the other asset. And of course, the prices will adjust until the actual yields are the same. This works with any asset, although it's kind of hard to calculate the risks with equities and real estate and derivatives and bonds. On the other hand, currencies are a more pure asset. So generally, weak currencies are going to have capital flow out of them into stronger currencies. Truly weak currencies may just continue to see capital outflow until the currency itself collapses. That's a dynamic that's driving this market. And the appeal of Bitcoin as digital gold is as a strong asset, and capital will flow to it. The second dynamic here is that we need to take into account is the technology dynamic, which is, digital gold is smarter, faster, stronger money. It's not just harder money. It's smarter, faster, stronger. It's monetary electricity, and it's monetary electricity flowing on a network. And Ross made this point. So you can build Bitcoin into any financial product, or you can build it into any technical product. And so that means that Bitcoin as digital gold is interesting as a hard money asset to any corporation handling money. But Bitcoin as a monetary network is interesting to any corporation that has financial products or technical products. And so I'll leave those as two high-level thoughts. Now moving on to corporate strategy. What's every CEO think? What is the elements of corporate strategy? Well, first point, I want to grow my revenues and I want to grow operating income derived from the generation of revenues minus cost, operating income. Every company knows they want to drive revenues north and drive operating income north. Second idea, I would like to grow my assets and I'd like to grow my investment income. If I have $1 billion and it's generating zero, I have no investment income, I have $1 billion in assets. If I can drive that to be $10 billion in assets with a 20% yield and have $2 billion a year of investment income, better. The same idea of revenue holds for assets. So growing revenues, growing assets, and growing operating income and growing investment income, these are all objectives of a corporate strategy. And if we put on our shareholder hat, I want to create shareholder value and I want to preserve shareholder value. And the creation and the preservation of shareholder value is somehow, in many ways, related to how I drive revenues, assets, and incomes after we take into account the leverage on the balance sheet. So the next thought that colors our considerations here is in a macroeconomic environment where the currency is weakening, the road to serfdom is working harder, ever harder, to earn a currency growing ever weaker, and then investing the proceeds of that work into assets that are growing ever riskier. Or even worse, to surrender your capital base completely. For example, you wouldn't really think twice about if you had savings in your family, you wouldn't give them all away before you had your first child. You would think, I need to have money so I can support my children. So family would want to accumulate assets, not give them away. On the other hand, we're in a macroeconomic environment where there's continual pressure on corporations to surrender their assets, to either buy their stock back, which is a way of surrendering assets, or to issue dividends, which is another way of surrendering assets. So why do people buy their stock back, and why do they issue dividends? Well, the view is their cash and their treasury is not beating the cost of capital. So if the cost of capital is 5% and you're getting 0% yield on your cash, you're under pressure to surrender your treasury assets. And of course, that's good for the shareholders, but it's awful for the company because the company is decapitalized. It's the same as giving away all your family's assets. It's good for whoever got the assets. It's bad for your family. What's really dysfunctional? Well, the idea that you would issue debt to pay a dividend. What if I borrow $1 billion, dividend out to the shareholders? Now the company owes $1 billion. The shareholders have the billion, and my customers and my employees just owe $1 billion. So issuing debt to pay dividends isn't really good corporate strategy. In fact, you see the last 20 years is littered with bankrupt companies that actually did LBOs. They leveraged buyouts, they issued debt, they paid huge dividends to their shareholders, and then the company itself is rendered insolvent by misfortune or difficulty in business. Issuing debt to fund operating losses, not much better. If the company is losing 100 million a year after year, and it just borrows $1 billion and keeps losing money, that's also a road to serfdom. Funding consistent business failure with debt is just putting off the inevitable. Issuing debt to buy your stock back, not really much better. If you issue $1 billion of debt, buy $1 billion in stock back, well, the shareholders have take off with the cash. They look to invest it, but your company has $1 billion in a liability. You've created a little bit of leverage, but you burden yourself with liabilities. Now, why do companies do these things? Well, because debt is cheap and because they're under massive pressure from outside groups to generate a positive return on their capital. And as the cost of capital keeps going up, they can't, or at least you can't with traditional treasury strategies. If you're investing in government bonds or T-bills and the cost of capital is 7%, well, you're not beating it. When the cost of capital goes to 15%, and that's about where we are right now, probably 15% or more, there isn't any conventional treasury strategy that's going to yield more than 15% risk-free interest. What happens next is there's this massive pressure to give the capital back to the shareholder because they realize that shareholder value is not going to be preserved in cash. Now, that's a way of capital preservation. If I take tens of billions of dollars and I dividend it back to shareholders, the capital is preserved because they're going to presumably invest in something that will beat the cost of capital. But it's a method of corporate destruction. The companies, which create the jobs and they create the products and the services, they're being destroyed as the capital flees into some other place. So what causes this? It's macroeconomic pressure. If the environment was only growing the money supply at 2% a year or 1% a year, there wouldn't be so much pressure. When the macroeconomic wind is blowing at a 5% monetary expansion, which is what we've been in for the past decade, there's a lot more pressure. When the cost of capital goes to 15%, becomes extreme pressure. And now every company has to make one or two choices. You either have to decapitalize, which is kind of like self-destruct. You're going to, capital is lifeblood. You're going to self-destruct, or you have to recapitalize with an asset which is going to appreciate faster than the rate of monetary supply expansion. This is where Bitcoin comes in. Now, I think there's a useful metaphor that you can use to try to figure out what's a good corporate strategy with regard to Bitcoin. And I'll call it the parable of the Argentine rancher. Let's say you have a ranch in Argentina, and it's a profitable ranch in Argentina. And this is sometime in the distant past, 10 years ago, 20 years ago. And what if I told you macroeconomically that you can expect the Argentine peso to weaken versus the US dollar by about 25% a year? This is not such a far-fetched idea, because the peso went from 1 peso to the dollar, to 2 to the dollar, to 4 to the dollar, to 8 to the dollar, to 10, to 20 to the dollar, to 40 to the dollar, to 60 to the dollar, to 80 to the dollar, to a black market rate in excess of 100 to the dollar. So the Argentine peso has collapsed against the US dollar in that range. So let's say you're a really intelligent business person and you run that Argentine ranch. If you knew this was going to happen, if you knew the Argentine peso was going to weaken in purchasing power against a benchmark, and the benchmark we'll say is the US dollar, what's a rational corporate strategy? Okay, by the way, this is not that hard. First, you're going to take 100% of your Argentine pesos in your treasury, and you're going to convert them to US dollars. Because if you have $100 million in pesos, when it's 100 million pesos, if you look out, eventually you're going to have 100 million pesos worth $1 million, and you're going to lose 99% of your wealth. Okay, so you convert your 100 million pesos into $100 million. First step, simple step. Next, I'm generating 10 million pesos a year from the business in cash flows. What are you going to do? You're going to convert all 10 million pesos every year into dollars immediately. As soon as you generate peso in cash flow, it becomes a dollar. And if you do that over 10 years, you're going to have 100 million pesos become the discounted amount of dollars. It won't be $100 million because the discount rate is 25%, but you'll capture 25, 30 million US dollars worth of value. If you don't, your 100 million pesos over 10 years will be worth $1 million, right? So you're capturing $24 million instead of $1 million by converting your cash flows. What would you do next? Well, if I know that I'm going to have 100 million pesos over the next decade that have a net present value of $25 million if I convert them immediately, what if I go to a bank in Argentina and I finance the cash flows? I go and I borrow 100 million pesos now against the next decade of cash flow. I convert the 100 million pesos into $100 million. And so instead of waiting to lose $70 million or $75 million worth of cash flow value, I immediately lock in the next 100 million. So I finance my future local currency cash flows because they're weakening. So what would you do next? Okay, I converted 100 million pesos of cash into $100 million, and I saved a $99 million loss. Then I financed 100 million pesos into cash, and I saved another $99 million loss. Okay, so I'm up $200 million. What would I do next? Well, I would go and finance all of my fixed assets on that ranch. I've got all this property. There's no debt against it. I put a mortgage against it, and maybe I put 100 million peso mortgage against that ranch. I'd convert that to dollars. And when 10 years have gone by, I'll have another $100 million. So I have 300 million US. If I don't finance my ranch will be worth 100 million pesos in 10 years, and that 100 million pesos will be worth $1 million. So it's another 99% destruction. Okay, finance your cash flows, finance your fixed assets. What would I do next? you know, well, I might actually think in terms of issue equity in my ranch. If I could actually sell ownership, let's say my ranch was worth 100 million pesos, I might sell 100 million pesos worth of stock in the ranch, convert that into $100 million, and otherwise in 10 years, I'll have a ranch worth 100 million pesos in stock, which will be worth $1 million. So you would basically finance anything you could finance. You would you would issue equity in the local currency and convert into dollars. And those are all balance sheet activities, right? I'm basically converting cash, financing cash flows, financing fixed assets, and I'm issuing equity in the currency, which is going to weaken so as to buy the currency, which is going to strengthen or hold its value. Now, that's the balance sheet side. What about the P&L side? Well, on the P&L, I would want to shift my sales to markets that pay me in US dollars. So if I can sell my existing product, my steaks, my whatever, into the US and get paid in dollars, then that's probably a good idea, because $100 million a year worth of sales is going to be worth $100 million every year for the next 10 years. If I keep 100 million pesos a year worth of sales, then they're going to collapse. So my revenues will collapse. If they're in Argentine pesos, they'll continue, they'll hold their value in dollars. So I would redirect my sales and marketing to the hard currency market. Now, I would probably, what if the United States market or these other markets required a special type of product? Maybe I have to freeze dry or I have to package my steaks to ship them long distance. I'd create a new product for that market that I could sell in US dollars. If I'm a CFO, I would want to enter into contracts that are denominated in, I want my revenues to be denominated in US dollars. I want my costs, my purchase contracts, to be denominated in local ARS, in local pesos, because that way my costs will collapse, whereas my revenues will hold their value. It will look like my revenues are exploding through the roof. It'll look like if I'm selling in dollars, converting back into pesos, it'll look like my revenues went from 1 million pesos to 2 million to 4 million to 8 million to 16 million to 40 million to 100 million to 200 million, et cetera, because I'm shifting between those two currency systems. Ultimately, what I want to do is I want to expand my business in the strong currency, i.e. the USD markets. And I might even decide over time to relocate my entire business. If you take this to the extreme, sell everything, convert to USD, and then relocate large portions of my business or my marketing operation to USD markets. So that is, in essence, a hard money strategy. That strategy is the playbook that any corporation in any country on earth that had a collapsing currency or a weakened currency would pursue rationally, even without considering the technology component we have at play here, right? If digital gold, if Bitcoin is just digital gold and it's harder money, then this is a macroeconomic idea that you want to be thinking. Now, it's more than that, right? Because Bitcoin is a monetary network, so there's a technology aspect which provides another opportunity for CEOs, but we'll come to that in a second. So, big idea. Let's talk about Bitcoin. Corporate strategy for Bitcoin. If you want to maximize shareholder value, you want to preserve or create shareholder wealth, then you can either work on a balance sheet strategy for Bitcoin, or you can work on a P&L strategy for Bitcoin, or you can do both. The balance sheet strategy for Bitcoin is convert your fiat cash flows, your treasury, into Bitcoin as much as you think you can. Second, convert fiat derivatives into Bitcoin. If you have investments in stocks, bonds, real estates that are denominated in the fiat currency, which you expect to weaken, right? You won't be protected over the long term, because if you have a stock which is going to generate $1 billion worth of pesos, and the peso is going down by 99%, the stock is also going to depreciate in the same way. So if you're a corporation holding a treasury in cash, you convert it to Bitcoin. If you're holding a treasury in stocks, bonds, real estate, or other cash derivatives that are valued based upon cash flows, you would also sell those, convert those into Bitcoin. You could issue debt in dollars, and then you can convert the dollar proceeds, the fiat proceeds, into Bitcoin. This works, by the way, in pesos. It works in euros. It works in any currency. You in essence issue debt in the local currency, and you convert it into the strongest monetary asset, which is Bitcoin. You could also issue equity, right? If you've decapitalized your company, if you're running with a very thin, if I'm Apple Computer, instead of issuing $100 billion of debt and buying back $100 billion of stock, maybe I issue $100 billion in equity, and I buy $100 billion in Bitcoin, because if Bitcoin is appreciating at 200% a year, and you're investing in a company that's growing its cash flows at 20% a year or 10% a year, it's dilutive to the shareholders, right? You want to actually invest in the thing that's appreciating the fastest. And right now you've got 10 years of history of Bitcoin appreciating at 200% a year. If when you decide what you're going to do, you have to consider, is your forecast 100% a year, 50% a year, 20% a year? What is the appreciation rate you're going to forecast? I think that it's very reasonable to expect that a strong money asset is going to appreciate at the rate of money expansion, plus with an additional driver of technology utility and technology diffusion or adoption, with a third driver, which is just broad-based network adoption. And all of that gets you to a number which is in excess of the expansion of the M2 money supply and the cost of capital. So convert your cash derivatives, and then issue debt, and then issue equity, and then if you can, finance your future cash flows, or convert your future cash flows directly into Bitcoin, right? These are all balance sheet strategies you can pursue depending upon what your balance sheet looks like and how financeable your company is and what kind of access to equity or debt lines you might have. Every company on earth can do that, right? Every company has some amount of treasury and assets. And if you're highly levered, right, you can issue equity to get less levered. If you have no debt, you can issue debt. And if you have debt that's invested in something, you can refinance it. So the balance sheet strategy applies to 100% of companies. What about the P&L strategy? Well, P&L strategy consists of the following ideas. Number one question: can I build an open product powered by Bitcoin? And can I build a product powered by Bitcoin? What does that mean? Well, let's say I have a mobile payment application like PayPal or Square. If I allow you with one click of a button to convert 10,000 US dollars into $10,000 worth of Bitcoin, I've created a mobile app, and it's plugged into the Bitcoin monetary network. And of course, I'm going to give my customers one button to convert a $10,000 liability that's going to depreciate in value by 15% a year into a $10,000 asset, which is going to appreciate in value at 100 or 200% a year. That's a product powered by Bitcoin. Now, what is it? What do I mean when I say open or closed? if I allow you to buy a whole Bitcoin, and I also allow you to take custody of the Bitcoin and transfer it to a hardware wallet or to a different custodian, it is an open system, open product. And I might very well get 100 million new customers that want to buy a Bitcoin on my mobile app and move it to another custodian. Coinbase has an open product powered by Bitcoin. What about closed product, closed system? Well, what if I actually let you click the button and buy a Bitcoin, but you can't move it off of my product, off of my mobile device? That's closed or proprietary. Okay, well, on one hand, it's less appealing to people that want to be able to take custody of their product. On the other hand, it would be more appealing to the shareholders of your company, because if $100 billion of Bitcoin gets purchased on your mobile app and you can't move it off of the mobile app, you become a bank with $100 billion worth of permanent capital. If you have a business model that generates a 1% fee, then you're going to get 1% of $100 billion. And you're going to get it until your customers exit that relationship. And if you have a closed or proprietary system, they would have to sell the Bitcoin and pay capital gains tax to exit. And that might be, if the capital gains tax goes to 45% and you have $100 billion of capital tied up in your mobile app, then your customers will have to incur a $45 billion tax in order to exit your mobile app. So that's kind of customer lock-in. Okay, well, if you're a libertarian, you're going to hate that idea. You're probably not going to want to buy that app. If you're tax efficient, you're going to hate that idea. But, maybe I make it easy. I give you low fee or no fee, or maybe I give you 2% back, or I give you a benefit, or maybe just people want to do it because I'm the only game in town. I suspect that if Apple or Google let you do this and they deployed it to 1 billion people, they would probably have hundreds of millions of people that might not mind being in a closed system. I mean, after all, lots of us have our photos or communications or digital rights or our passwords locked up in some of these cloud-based systems from Apple and Amazon and Google. And so you can actually capture the Bitcoin asset into a closed network, or you can have it in an open network. It's a business strategy. I have opinions about what I like. Other people have opinions. But the point is, when you're sculpting your product, you decide, is it a proprietary product or an open product or a mixture of both? And there's a continuum there. You can also drive revenues on your P&L by building Bitcoin tools. You can build software tools. You can build hardware tools. And of course, you can offer Bitcoin professional services that are critical to everyone in the space. So all of these things will drive revenues, and they'll drive cash flows if you choose to enter the space. So let's rifle through some examples of companies right now. Grayscale. Grayscale offers a closed-end fund, and it's powered by Bitcoin, and it is an example of a closed product. So if $10 billion flows into the fund, then that gets converted to Bitcoin. They issue shares. The shares might be sold in the open market, but the Bitcoin, the $10 billion of capital, stays in the Grayscale product. If Bitcoin doubles and doubles and doubles again, eventually Grayscale has $100 billion worth of assets. If their business model is a 2% fee a year, they'll eventually have $100 billion of assets with $2 billion in revenue, growing at the rate of the Bitcoin monetary network forever. It's a good business. It's a great business. It's very interesting. Fidelity. Fidelity has a different business strategy. They have Fidelity Digital Assets. You can buy Bitcoin on the Fidelity Digital Asset platform. You can custody it with them. So they generate fees from custody. They generate fees from buying and selling for you. and you can take delivery of your Bitcoin. You can move it off of their custody platform into your hardware wallet. So it's more of an open product rather than a closed product. But they've got this this custody solution which is ongoing, and to the extent they offer you good services, then they will accumulate billions and billions of dollars of assets and expand that business over time. NYDIG. NYDIG is an example of a business that's a hybrid. They've invested their balance sheet in Bitcoin. They have substantial treasury holdings in Bitcoin, and they sweep cash flows into Bitcoin. And on the other hand, they offer brokerage services and custody services and value-added products, and they offer funds. And these are all products that are powered by Bitcoin, and they all meet a different requirement. So they're actually driving revenues, driving operating income, driving assets, and driving investment income all at the same time. PayPal. PayPal has more of a closed product. They make it very, very easy to buy Bitcoin and perhaps to sell Bitcoin. It's not so easy to take delivery of the underlying Bitcoin. When 100 million people have bought Bitcoin on the PayPal platform, they will have migrated tens of billions of dollars of capital onto the PayPal platform. They're in essence a consumer bank, using Bitcoin as a monetary asset. Square has offers you the ability to buy Bitcoin, trade Bitcoin. They're more open with regard to Bitcoin, and they will allow you over time to take custody. And so it's a slightly different strategy. Marathon is a Bitcoin miner. They actually have on their P&L a very direct idea, mine Bitcoin. But on the other hand, on their balance sheet, they bought Bitcoin. So they also are exposed on the balance sheet and the P&L. MicroStrategy. MicroStrategy has a balance sheet exposure to Bitcoin. We actually converted our treasury into Bitcoin. We sweep our cash flows into Bitcoin. And we've issued debt, which we then convert into Bitcoin, right? So we've got a leveraged balance sheet strategy for Bitcoin. Coinbase is actually trading and offering custody services and other related services, and a fairly open model on top of Bitcoin. Binance has got a broad range of services, and they're moving in. Not only are they trading and custodying services, but they also offer derivatives for futures, calls, puts, etc., and even payment type services. And they're evolving into a broad-based consumer and institutional bank for Bitcoin. Bitmain generates hardware. They create hardware that you can use to mine Bitcoin. It's a very special purpose tool for Bitcoin. So what are the general opportunities here for Bitcoin P&L strategies? You can get in the mining business. If you get in the mining business, you're going to want to find a clean, cheap, renewable source of energy. But anybody can do it anywhere in the world. It crosses all regulatory jurisdictions. You can be an exchange. You're going to want to have exchange capabilities. You can broker Bitcoin. You can be a custodian of Bitcoin. You can be a bank. You can be a commercial bank where you're offering, extending loans or helping to generate yield or the like against Bitcoin as collateral. You can be a fund. A lot of corporations benefit from investing in Bitcoin as a fund. Funds under some circumstances can give you GAAP accounting treatment and investment income, which is more favorable on a balance sheet or a P&L than having intangible asset accounting treatment. So I as a company might want my Bitcoin to be held in a fund, either because it's easier, I can execute quicker, or it's more secure, or because of my charter doesn't allow me to hold the underlying asset, or because I prefer the accounting treatment that a fund might offer me. And so this is valuable. You can be in the derivatives market for Bitcoin. Here's an interesting one. Bitcoin's going up at 200% a year. The world's full of people that are afraid to own it, even though it's going up on average 200% a year over a decade. On the other hand, they would, if JP Morgan or Morgan Stanley said, we will guarantee you 10% taxable yield every year, you would have hundreds of billions of dollars flowing into those products. If you gave someone a structured product that guaranteed 10% yield, you could keep the other 90% yield. So if you create a bank that issues a structured bond, a bond that yields 5% or 10% or 20% over 5 years or 10 years or 30 years, people would buy that, and you could keep the extra 170% yield. All you have to do is post the equity as the collateral, and then you have to be a creditworthy counterparty. So you could think of this as like a Bitcoin swap. In traditional markets, people would say, I'm going to guarantee you 160 basis points, and in return, you're going to pay me the short-term interest rate. That's a swap, short-term rates versus a fixed long-term rate. Well, if you give someone a fixed 10% yield on Bitcoin, give me $1 million, I'll invest in Bitcoin, I'll give you 10% forever, but you give me everything above 10%, that would be pretty lucrative, right? So there are interesting financial businesses where you get into issuing swaps and issuing bonds. All you got to do is be a credit-worthy counterparty and have some equity capital so you can stomach the near-term volatility. This is a nation business. A similar angle on that is insurance. Right now, insurance, people buy insurance, they pay premiums. Those premiums are getting invested on insurance company policies into things that yield 3% a year. Imagine if I took your insurance premiums and I invested in something yielding 30% a year. Imagine if I invested in something yielding 150% a year. You could, in theory, give someone a life insurance policy where they pay in $100,000 of premiums, and then, on their death, it pays their heirs $50 million, right? Some huge amount of money. Or you could reverse it, and you could offer people life insurance policies that cost 1/2 or 1/3 in premium by investing a portion of those funds into Bitcoin instead of into 30-year swaps, because a 30-year swap yields 160 basis points for 30 years. It's an awful instrument, and yet people fund with it right now. So insurance is ripe to be disrupted. Credit card is another interesting P&L strategy. People pay 12 to 20% for unsecured loans from credit card companies. What happens when they actually post Bitcoin as the collateral? If I basically moved my Bitcoin to you and you gave me a 6% loan or a 3% loan, I could eliminate all that unsecured debt. In fact, you could pretty much rip tens or hundreds of billions of dollars of capital away from the credit card companies, and you could move it to a consumer bank that uses Bitcoin as collateral and issues consumer loans against those. And that takes you back to the PayPal example. PayPal talks about they're going to allow you to fund your purchases off of a Bitcoin account, but really the future of this business is I post $50,000 of Bitcoin or $20,000 in Bitcoin, and then I borrow against it. And as Bitcoin appreciates, I never sell my Bitcoin. I never incur capital gains tax. I pay 5% interest against an asset appreciating at 50% a year forever. And so you can reform consumer debt. If you're a device company, look, the screaming opportunity for Apple Computer is build a hardware wallet into an iPhone, or build multi-signature into the Apple Watch, the iPhone, and the iCloud. There's a world where you will be able to take your Bitcoin off the network, move it. What is it? Cold storage, or is it sort of the key is sitting multi-sig between the iCloud, your iPhone, and your Apple Watch in some secure relationship. They can build the secure elements into the computer, into the wearable, into the hardware device, into the phone, or into the back end of the network. I think this is an opportunity for Samsung, for Apple. If you build software like Microsoft, you can build support for Bitcoin into Windows. You can build it into Android. You can build it into iOS. You can build it into all your cloud offerings. You can build it into your backend server offerings, and anybody in the hardware business probably has a play here. If you're a semiconductor company like Qualcomm or Intel, the obvious play is to actually start to spit out SHA-256 ASICs or secure elements of the like. And you know, it's a market that's going to explode. If you do data centers like AWS or Microsoft or Google, well, you know, the greatest data center is that Bitcoin miner. And if you create modular Bitcoin mining data centers and you're back-end integrated into semiconductors, you could drop them in the middle of Africa, you know, on a pad next to shut-in or stranded energy, and that could be an interesting thing. Software companies, well, we already talked about the operating systems, but for Facebook, you know, for any kind of messaging company, you can build support for the Bitcoin protocols and the Lightning protocols into Twitter, into Signal, into WhatsApp, into Messenger applications, into any social network, any communication network, and that's the network opportunity. I don't really have time to discuss all of those right now, but I'll just move on to just one final set of thoughts, which is there's a macroeconomic wind blowing. It's going to impact $400 trillion of capital. That capital is sitting in fiat instruments that are being debased. That capital is going to want to convert into strong money. And so if you support an on-ramp to convert that layer of money in that regulatory jurisdiction into Bitcoin or a derivative of Bitcoin, you've got a massive business. So think about a Cartesian system. There are layers of money, there are jurisdictions. Consumer savings is type of money. Retirement accounts is a type of money. Institutions have money. There are equity funds with money that can invest in the stock market equity. There are debt funds. They have another flavor of money. There's corporate cash, treasury reserves with another flavor of money. There's state and local governments with flavors of money, pension funds, annuities, federal governments, futures and options market. They're all flavors of money. In the US, there's a sort of regulatory jurisdictions. If you can solve the compliance issues, you can convert that flavor of money into a Bitcoin derivative. It'll be a different problem in Argentina. It'll be different in the EU. It'll be a different set of regulatory jurisdictions in the UK or any other country. So if you're in this business, you have to solve the regulatory compliance issues that are changing. Then you have to offer a product for that flavor of money. And don't fall into the trap of thinking that there's one size that fits all. There isn't. There's someone who can click on a button in PayPal and they can buy some Bitcoin, and that's all they can do, and they'll be happy. And there's a corporation that can buy a Bitcoin fund and they can buy $1 billion of it in a day, but that's all they can do, and they'll be happy with that. But they can't buy the one in the UK or Malta. And there's a company in the UK that can buy it a different way. If you solve the problem of how you transform the layers of money in the jurisdictions into Bitcoin derivatives, then you're going to see trillions of dollars of capital flow, and you will either capture the capital in your bank or in your app, or you'll enable it and you'll get paid. So with that, I want to wrap up with just a big idea. If you have a weakening currency, right, the real issue is capital flight. Capital flight from the nation, capital flight from a company, capital flight from a family. If you're a corporate CEO, you need to preserve your capital, then you need to invest your capital in something which is strong money that's going to appreciate faster than the rate that the capital and your cash flows are losing their purchasing power, right? So, like, stop the bleeding, right? The idea that you should give up all your capital and decapitalize the company, leverage yourself up, is the equivalent of bleeding George Washington to death, right? The physicians thought they were going to save his life by bleeding all of the toxins out of his system. But capital is blood. It's not a bad thing. When the cost of capital goes up, then the solution is not give up all your capital. The solution is expand your balance sheet and invest the capital into strong money that's appreciating faster than the rate of money expansion. All of these corporate strategies, they all come down to the same idea, which is generate strong money, find a way to attract strong capital, attract Bitcoin or Bitcoin derivatives as revenue, find a way to generate operating income based upon those strong revenues, find a way to hold that capital on your balance sheet, and then make sure that you're converting and financing all of your other assets, which are fiat derivatives, into the strongest monetary asset you can. If you do those things, then there's no reason to think that your purchasing power won't appreciate, your revenues appreciate, your income, either operating income or investment income, will appreciate. Your shareholders obviously will react favorably to that. Shareholder value will appreciate. Your stock price should go up in the public market, and the private market, your balance sheet and your earnings will simply appreciate. And that should continue for quite a while, right? We're at the beginning of a very, very long trend here. And so with that, I have more stuff to say. I don't have time to say it, but follow me on Twitter and stay tuned, and we'll share more on these topics as time goes by. And meanwhile, I will cede the floor, and we'll be moving on shortly to our session on the corporate playbook and legal considerations and finance considerations. So thanks for being with us today.